Right now, there are millions of robots working every single day inside factories, warehouses, hospitals, and logistics centers around the world. Not prototypes, not pilots, real machines doing real work at scale. According to industry data, there are now over 4 million industrial robots actively operating in factories worldwide, a number that has more than doubled over the past decade. That alone should tell you something important has already changed. What matters just as much is where this is going next. Industry forecasts now expect that number to climb towards 7 to 8 million industrial robots globally by the early 2030s, driven by automation in manufacturing, logistics, healthcare, and infrastructure. Most people think robotics is about machines. It's not. The real value is in what those machines teach the systems behind them and who owns that learning. That's the part almost nobody is pricing correctly. In this video, I'm going to show you why most robotics investments miss the real opportunity. We'll break the industry into 4 tiers, look at where value actually compounds, and at the end, I'll show you a portfolio in the 4 tiers of robotic stocks that could potentially turn a $10,000 investment into a $10 million portfolio over the long run. But before we get there, we need to understand why most investors misread the robotics story. Many investors think robotics is important but still early, something that'll matter more in, say, 5 or 10 years from now. That view is understandable. For decades, robotics was expensive, slow to evolve, and limited to tightly controlled environments. But that mental model no longer fits what's happening. While headlines focus on flashy demos, the real shift is far more consequential. Robots aren't isolated machines anymore. They operate as connected systems. Each robot feeds data into shared intelligence. Each improvement spreads across the entire fleet. Once that loop exists, progress stops being linear. This is why robotics doesn't arrive in a sudden, dramatic moment. There's no clean adoption curve. Capability builds gradually. Then efficiency suddenly jumps, and those jumps only become obvious after the fact. That's where investors get tripped up. If robots are already widespread, why don't all robotic stocks behave the same way? Why do some compound while others stall even though they're tied to the same trend? The problem is that most investors still analyze robotics the old way. They count robots, factories, and deployment rates. If one country or company installs more machines, it's assumed they're winning. That logic made sense when robotics was purely physical, but robotics behaves differently today because its economics flipped, slowly but completely. In the old model, robots were rigid. Every movement was programmed by hand. If a task changed, engineers rewrote code, tested it, and deployed it one machine at a time. That worked on a small scale. It broke on a large scale. Each robot operated in isolation. Improvements had to be copied manually. Learning was slow and expensive. Scaling meant repeating the effort. That's no longer how robotics works. Today, intelligence lives in shared models. Instead of programming thousands of robots individually, one system is trained centrally and deployed across an entire fleet. Every robot runs the same core intelligence adapted to its specific environment. That changes the math. Training intelligence can be costly up front, but once trained, deploying it to one robot or a million costs almost nothing. The marginal cost of intelligence collapses. Improvement becomes software-like. Now every robot becomes a sensor. Every mistake, correction, and edge case is captured and fed back into the system. The next update reflects the experience of the entire fleet at once. Robots don't just execute tasks, they learn collectively. This is why progress accelerates after years of slow buildup. Once the learning loop is in place, each deployment makes the next one easier. Each improvement spreads instantly. We've seen this before. In smartphones, the companies that shipped the most devices didn't capture most of the value. Software, platforms, and ecosystems did. Robotics is following the same pattern. As machines get cheaper and easier to deploy, installation alone stops being special. What matters is adaptability, learning speed, and whether the system improves over time. Scale without differentiation doesn't protect margins. Intelligence does. It also explains why leaders pull away. Which leads to the next question. Where does that value actually live? This is where most of the confusion comes from. Robotics gets treated as a single trend when it's really a system with distinct layers. Once you stop looking at robotics as one category and break it into tiers, the value map becomes much clearer. Value doesn't spread evenly across robotics. To make it simple, I've divided the robotics stocks into 4 tiers. At the base are the muscles. This is physical execution, robot arms, actuators, mechanical systems that turn digital commands into real-world movement. Nothing works without this layer, but over time, competition pushes it toward infrastructure. It becomes reliable, necessary, and lower margin. Above that are the eyes and nerves. Perception systems, cameras, sensors, machine vision allow robots to operate outside controlled environments. This tier is what lets robots adapt instead of repeat. Above perception is the brain. This is where intelligence lives: computing, training platforms, simulation, and orchestration software. This layer compounds learning. Data from every robot gets turned into better decisions for the entire system. At the top are the operators. These are the companies that deploy robotics so well that it becomes a moat. They don't just buy machines, they integrate systems, coordinate them in real time, and continuously optimize workflows. This is where robotics turns into operating leverage. Here's the critical insight. As robotics scales, value migrates upward. Physical execution becomes standardized. Middle layers compress. Intelligence and orchestration capture a larger share of the upside. Every layer matters. The system collapses without the base, but from an investment perspective, not every layer compounds the same way. Some grow steadily, some accelerate, and some get squeezed as competition increases. So with the map in place, let's start with Tier 1, where everything physical actually happens. Tier 1, the muscle layer. This is where digital instructions turn into real-world action. Robot arms, actuators, precision tools, and systems that move, cut, lift, and manipulate objects with accuracy. Nothing in robotics works without this layer. Every higher level depends on it doing its job reliably every single time. Boston Scientific fits here cleanly. At its core, the company builds robotic systems that execute physical tasks with extreme precision, primarily in medicine. These aren't consumer robots or experimental platforms. They're clinical tools designed to operate inside the human body, where tolerances are measured in millimeters and failure isn't an option. What makes this a robotic story isn't the medical setting, it's the function. Boston Scientific's systems convert digital commands into controlled physical movement. Catheters bend, rotate, and deliver energy with sub-millimeter accuracy. Mechanically, it's the same logic as an industrial robot arm, just miniaturized and refined for living tissue. This also explains why Tier 1 behaves differently. As robotics spreads, demand for precise execution grows steadily. Hospitals adopt robotic systems for consistency and outcomes, the same way factories adopt automation for reliability. But progress here is incremental. Better designs, tighter tolerances, wider adoption, no sudden leaps. That doesn't make this tier less important, it just makes it foundational. Without reliable muscles, intelligence doesn't matter. But from an investment standpoint, this layer usually compounds at a slower, more predictable pace. It benefits from scale, but it rarely produces explosive upside on its own. That steady profile shows up in how the market views Boston Scientific. Analysts broadly rate the stock a buy, with average targets implying roughly low 30% upside over the next year. That outlook fits the role this layer plays: durable demand, improving adoption, and predictable growth rather than speculation. This is also why Tier 1 often gets overlooked. It doesn't look like AI. It doesn't promise breakthroughs every quarter. It just works. And that's the point. Tier 1 sets the floor. As robotics expands, someone has to build the machines that physically interact with the world. That creates real value, even if it's not the most dramatic part of the robotic story. But precise movement alone isn't enough. Robots only become transformative once they can understand what they're interacting with. And that brings us to the next tier. After this, I'll show you 2 more tiers of robotic stocks, and at the end, I'll combine all of them into a single portfolio, run the projections, and show you how this structure could potentially turn a $10,000 investment into a $10 million portfolio over the long run. But first, let's look at Tier 2, the eyes and nerves of robotics. Tier 2 is all about perception, cameras, sensors, and machine vision systems that translate the physical world into data a robot can understand. This is what allows robots to leave cages, operate safely around humans, and function in environments that don't behave the same way twice. And the company sitting here is Teledyne. This company builds advanced imaging and sensing technologies that give robots perception beyond human eyesight. Thermal imaging, infrared, multispectral sensors, tools that allow machines to see in darkness through smoke, fog, or visual noise. In robotics, this isn't about prettier images, it's about reliable perception when conditions are imperfect. That reliability is the key. A robot that can't see consistently can't operate autonomously. It either slows down or fails. Teledyne's strength is depth and integration. It doesn't just sell a camera, it builds the full perception stack, from sensors and optics to the software that turns raw signals into usable information. That end-to-end control is what makes perception dependable at scale. From an economic standpoint, Tier 2 compounds differently from hardware. As autonomy increases, the demand for high-quality perception accelerates. Every new robot deployed into a complex environment increases the value of better sensing. And unlike basic hardware, perception systems don't commoditize as quickly because failures are expensive and reliability matters more than price. That dynamic shows up in how the market views Teledyne. Analysts generally rate the stock a buy, with average targets implying high teens upside. That reflects steady confidence in its role as a critical supplier to automation, defense, and advanced robotics, rather than expectations of speculative hypergrowth. Tier 2 often sits in a sweet spot. It's more leveraged to autonomy than physical hardware, but less exposed to hype than pure AI narratives. As robots spread into warehouses, infrastructure, and outdoor environments, perception becomes a bottleneck, and companies that solve bottlenecks tend to benefit consistently. This is also where the handoff to the next layer begins. Seeing creates massive amounts of data. Every frame, every signal, every sensor reading feeds into a decision. But perception alone doesn't decide what to do next. For that, robots need intelligence that can process all of this information instantly and learn from it over time. For that, robots need a brain. This layer is where intelligence actually lives. Computing platforms, training systems, simulation environments, and orchestration software that decide how robots behave. It's the part of the system that turns raw signals into decisions, and decisions into learning. NVIDIA sits at the center of this tier, not because it builds robots, but because it provides the infrastructure that allows robots to think. Its hardware runs the models that interpret sensor data, plan movements, and react instantly to changing conditions. But the more important piece isn't just the chips, it's the ecosystem built around them. Modern robotics doesn't learn in the real world first, it learns in simulation. Before a robot ever touches a warehouse floor or a factory line, it can be trained through thousands of virtual scenarios. It learns how to navigate obstacles, handle edge cases, and respond to failures before those failures ever happen in reality. That compresses years of trial and error into weeks. This is where NVIDIA's advantage compounds. Its simulation and training platforms allow developers to create digital twins of real environments and train intelligence at scale. Every improvement made in simulation can be deployed instantly across fleets of robots in the physical world. Learning becomes centralized, fast, and repeatable. This is also where skepticism naturally shows up. NVIDIA is already one of the largest companies in the world. It's reasonable to wonder how much upside is left when a company is already this big. That question makes sense, but it misses how platforms grow. When a company controls the intelligence layer, growth doesn't come from selling more units one by one, it comes from deeper integration. More use cases, more dependence on the same underlying system. As robotics spreads into new industries, the same intelligence gets reused again and again. That's why it makes sense to adjust expectations. NVIDIA's historical growth has been extraordinary, but forward-looking assumptions are more conservative. Even at a lower growth rate, the compounding power of owning the brain layer remains intact because margins, scale, and ecosystem lock-in behave differently here than in hardware. Analysts seem to recognize that distinction. NVIDIA is broadly rated a strong buy with average targets implying roughly 40% upside over the next year. That optimism isn't about chasing hype. It reflects confidence in NVIDIA's role as the default intelligence platform behind modern robotics and AI systems. Tier 3 is where the biggest value concentration tends to happen. Intelligence improves everything above and below it. Better models make sensors more useful and hardware more efficient. And as learning compounds, the gap between leaders and followers widens. But even the smartest intelligence doesn't create value on its own. It has to be deployed, coordinated, and turned into real-world efficiency. And that is where the final tier comes in. This is the layer most people forget when they think about robotics. When most people think about robotics, they picture machines being built or software being trained. What they don't focus on are the companies actually running robotics at scale every day as part of their core business. Amazon is the clearest example of that. Across its fulfillment and logistics network, Amazon operates one of the largest robotic systems in the world. Not a single robot type, but many of them working together. Robots moving shelves, robots sorting packages, robots navigating around people. All of it is happening simultaneously across massive facilities that never stop moving. The advantage isn't any one machine, it's how everything is coordinated. Amazon doesn't win because it owns robots, it wins because it integrates them. Inventory movement, routing, picking, sorting, all of it is managed through centralized systems that consistently rebalance flow. When conditions change, the system adjusts in real time. This is where robotics turns into operating leverage. Small improvements stack up fast. Faster picking reduces congestion. Better routing cuts handling. Fewer touches per order lowers costs and errors. On their own, those gains look minor. Applied across millions of orders, they become enormous. This is also why this tier is incredibly hard to copy. You can buy similar robots, you can license similar software. What you can't replicate easily is years of operational data, custom workflows, and systems that have evolved together inside a live business. That is where the moat forms. From an investment perspective, Tier 4 doesn't always look like a robotics story. Amazon isn't marketed as a robot company, but that's exactly the point. Robotics shows up here as a margin expansion, not product revenue. Faster delivery, lower costs, more resilient operations. Analysts tend to reflect that view. Amazon is broadly rated a strong buy, with average targets implying high 20s upside. That optimism isn't about robots as a product line, it's about operational leverage driven by automation, logistics efficiency, and scale. Tier 4 is where all the previous layers finally pay off. At this point, the 4 layers start to come into focus as parts of a single system rather than separate bets. What makes these 4 companies interesting isn't that they're all robotics stocks, it's that each one represents a different way to value compounding as robotics spreads through the economy. Boston Scientific sits at the foundation. It's about execution, precision, reliability, and steady adoption as robotics spreads. Teledyne sits one level up. Perception is what lets robots leave controlled environments. As autonomy increases, better sensing removes bottlenecks and accelerates progress. NVIDIA sits above that. Intelligence amplifies everything below it. Better models improve sensors and hardware at the same time, which is why this layer captures the most leverage over time. Amazon ties it together. Robotics here isn't a product, it's efficiency. Automation shows up as speed, cost control, and a stronger operating engine that's hard to copy. Seen together, these companies aren't competing with each other, they reinforce each other. Each layer depends on the ones below it and amplifies the ones above it. That's why 2 companies can both be exposed to robotics and still deliver very different outcomes over time. This is also where the idea of a potential 10 times outcome needs to be framed correctly. It's not about one breakthrough product or a single year of explosive growth, it's about owning parts of a system that compound over a long period as automation becomes the default way physical work gets done. So let's make a portfolio of these tiers and look at the future projections. At the base, Boston Scientific sits at 20%. Historically, over the past 10 years, this stock has delivered an average share price appreciation of 18.73%. Teledyne also sits at 20%. Perception compounds slightly faster because as robots move into messier environments, better sensing removes friction everywhere else. Historically, that's shown up as 19.97% average appreciation, driven by demand rather than hype. The largest weight goes to NVIDIA at 40% because this is where learning and leverage concentrate. Over the past 10 years, NVIDIA's share price appreciation has averaged 71.71%, but the company is already enormous. Instead of extrapolating that kind of growth forward, expectations are normalized. For projections, I'm using a more conservative 35% annual rate, which still reflects NVIDIA's scale, platform economics, and ability to reuse the same intelligence across multiple industries without relying on unrealistic growth assumptions. Amazon rounds it out at 20%. Historically, it has maintained a 20.9% average appreciation. Blended together, this structure produces an average annual return of 25.92%. To put that into perspective, a $10,000 investment compounding at that rate grows to $12,592 after 1 year. After 10 years, it's projected to reach $100,218, which is effectively a 10 times return on the original capital. And that is where most people would stop and take profits. But the more interesting question is, what happens if you don't? By 20 years, that same $10,000 is projected to grow to $1,004,371. That's roughly a 100 times outcome, driven entirely by staying invested as compounding accelerates. Keep going, and by 30 years, the projections show a valuation of $10,065,641. That notably crosses into a 1,000 times territory, relative to the original investment. Want to know how a simple $5 a day investment can grow into a portfolio that pays more than $8,000 a month in dividend income? Click the video on the screen to find out.